This is Nick Radge, manager of the Harbourside Direct Equities Satellite Strategy, and today we'll be talking about July performance numbers. July, very, very quiet. Portfolio declined by 0.2%, and that was aligned with the equal weight index, which dipped about 0.6% through the month. The small ordinaries added 2.8%. The standouts in our portfolio for the month were Temple and Webster, and also Generation Development Group. So the ASX continues to lag all global indices. The US market was up nicely again in July, but international markets are also very, very strong. Interestingly, we've just had 3 positive months in a row. This is in the seasonal weak period that we've seen sell in May and go away. Now, this has happened 17 times since 1950. And this tends to lead to significant outperformance in the coming 12 months. That's obviously in the US market. So that's something that's quite interesting, and hopefully will give us a bit of tailwind over the coming 12 months. The low volatility that we've had in the last 3 months is unlikely to persist. August does tend to be a little bit turbulent, so we'll see what happens over the coming months. The portfolio does remain fully invested for the month of August. We can see here again, I've shown this before, this is the equal weight index. Our portfolio is an equal weight based or index unaware equal weight index. And you can see here the equal weight index here in Australia has basically gone sideways for 12 months. Very difficult to make money using a momentum style strategy when the market has no momentum whatsoever. So if we take a look at the key benefits of this portfolio for advisors, it will act as a diversifier for other regular long-only type strategies, and we'll show you shortly the low correlation to those traditional asset classes. It can complement and mitigate losses during market declines, especially sustained market declines such as the GFC back in 2008. Whilst we weren't using this specific strategy back then, our other strategies went to cash around June, July 2008 and stayed that way through till about April 2009. So we were able to sit on the sidelines whilst that market sold off quite heavily. We are built for growth. It's specifically built for outperformance, and with that comes some volatility. Being a quantitative strategy, we attempt to completely remove the bias out of emotionally charged market environments. June was a very good example of that, when the US went into Iran, and that caused a few investors to go to cash and miss some reasonable gains during the month of June. So the other benefit of this type of timing type strategy is that in broad, expanded sideways markets such as 1968 through to 1972, which we've proven in a white paper, or on the US market at least, and also in the 2002-2011 lost decade in the US market. These kinds of strategies can outperform in those environments, which is why it can be beneficial to add into a broader portfolio. I did mention the correlations. If we have a look at the satellite portfolio versus the ASX 200, 0.39 is the correlation, and against bonds 0.06, negatively correlated to gold, and S&P 500, no correlation whatsoever. So it can be a bit of a beneficial addition to a standard portfolio. As usual, if you have any questions, feel free to drop me an email, nick@thechartist.com.au. Thank you.